Hello, everyone. I'm going to go ahead and get started. I want to welcome you to a Alto's Trading Market Overview. Thank you guys for being here with us this evening. Got a lot of folks on a packed house. If this is your first time being on a webinar, you'll notice your microphones are muted. That's so that we can all hear Jeff talk. And you'll notice there's also a Q&A box, which if we have time to, we'll get to there later at the end of the call. I'm going to run through the disclaimer real quick to make the attorneys happy here. You can read through that. I got a lot of great information to cover tonight. It's an exciting time in the markets. We always time these things just beautifully, what's going on. So very glad to have everyone here with us. If you have to hop off for any reason, don't worry. It is going to be recorded, and we'll make it available to you either later tonight or tomorrow. So that being said, I'm going to hand the microphone over to Jeff. So Jeff, you want to grab the microphone?
All right. Thanks, Richard.
All right.
Hear me okay?
Perfect.
Great. Welcome, everybody. Thanks for joining. Like Richard mentioned, we seem to time these things at, it just seems serendipitous that we, set these webinars up and then something crazy happens in the market. But it's great for you guys because we can navigate through this and we can talk about just our overall view of the market, map out our levels so we have a good idea of where we may see support in the current sell-off. And then we'll talk about the rubber band effect. So this is a great technique that you guys can implement in your trading strategies to determine where the market may be going back up to, because as with any sell-off, the market always goes back up eventually. And we'll talk about some current opportunities in the market, and we'll hold a Q&A at the end as well. We generally don't do much Q&A in our free market overview sessions, but I wanted to give you guys a little bit of time to ask questions if you have any. These generally take us about 20 to 30 minutes just to run through what we want to cover. And so we should have a little bit of free time at the end to ask questions. And I'm not sure, I didn't hear if Richard mentioned or not, but you can type those in the chat box or the Q&A box, which you can find on the pop-up menu, I believe at the bottom of your screen. So, all right, let's go ahead and jump right in, get over to my platform. And we use the S&P 500 index as a benchmark for the overall market, to gauge the overall market strength and weakness. So we're going to be looking at the S&P 500 SPX, and we look at a daily chart, which I've got pulled up here on the screen. And of course, you can see the very extreme sell-off that's occurred over the past week or so. And we have now entered correction territory. So for those of you who aren't familiar with the metrics used to determine whether we're in a bull or bear market or in a correction, anything over a 10% sell-off from recent highs is considered a correction. And then if we hit 20% from recent highs, it's considered a bear market. So that's kind of the benchmark that is used in the industry to determine what type of market we're in. So we are definitely in correction territory now. We dropped over 4% today on the S&P, and we closed near the lows, which generally is, might indicate that we'll see further weakness in the market. You can see the last couple of days here. Let me zoom in. We've closed near the lows as well. And of course, the steep sell-off today. So the question is, where are we going to find support? Where is this sell-off going to stop, and where will we potentially see a rebound, which is inevitable? And then I want to talk a little bit about the catalyst behind this, of course, being the coronavirus, fears around the spread of the coronavirus and how that's impacting things. So that's really the main catalyst here. And there's just a lot of unknowns. So until there's a viable vaccine or cases start to slow, which I think are we'll likely see as the weather improves. This is a virus that is in the same family of viruses that cause other respiratory illnesses like the common cold and influenza. And so, of course, as people start spending more time outdoors and things like that, and temperatures increase, the spread of these types of illnesses tends to go down. We saw a similar thing with back on the SARS epidemic. Of course, they developed a vaccine for that one, and that certainly helped. And they have fast-tracked a vaccine candidate through the FDA for this current coronavirus. So until there's some more clarity around a solution for this global geopolitical event, then I think that we're probably going to see a lot more volatility in the market. But we certainly have failed to demonstrate any significant rebound from the sell-off at recent highs. We hold regular live trade sessions for our members, and we held one right before we topped out on the market. And we talk a lot in those sessions about levels in the market and how incredibly predictive they can be in terms of looking for accurate buying points in the market or selling points in the market. And we alerted our members on our last webinar that to watch out for the 3,400 level on the S&P as a potential selling point. And sure enough, although we didn't quite reach it, that's the level that we sold off from. So I want to start out by mapping out the levels on the S&P. This is the first kind of step in my process that I use when I manage my hedge fund, in terms of taking that high level overview of what the overall market's doing, where it's trading relative to significant levels on the S&P, and then making my trading decisions based on those levels. And what we look at, and I use this in my hedge fund, are the century marks on the S&P. So of course that would be 3,400 and then 3,300. And you'll find that often these levels are very significant in terms of price action. You'll see technical areas of support and resistance around these levels. So I'm just going to map these out here, 3,100. And then we broke below 3,000 today, which is significant. All right. And I'll zoom out here in a minute so we can get a bigger picture. But these are the major levels that I watch. And you'll notice that although they're not exact, you'll see that they do often coincide with, oops, sorry about that. Let me redo that. That they'll coincide with these century marks. So obviously we had some support resistance areas there. Down here by the 2,800 level, we had support. If I were to draw this line further out, we've got resistance. And we teach our students in terms of reading support and resistance, that once support breaks, it then becomes resistance, and vice versa. Once resistance breaks, it becomes support. So for instance, this 3,300 level, once we broke through that, then you can see we came back down, retested, then broke through it, then it became resistance. And of course, this was what was once a resistance level, then became support at 3,200. We broke back through 3,300, which then became support as it was previously resistance. So as we sell off through these levels, we want to be looking for potentially for a rebound or a close past one of those levels, because now these are all support, and once we get back above one, it will become resistance. And then I'm also going to talk about the bands that I have here on my chart. These are Bollinger Bands. They're a volatility study, and they can be really useful for determining basically where the market, once a sell-off occurs, where the market is likely to rebound to. So let's spend a little time on that. Let me clear out my drawings here. Because I want to make this clean so you guys can see it, to get a good picture of what's happening and what's happened other times we've had major sell-offs like we are in right now. So basically the bands tend to be closer together in periods of lower volatility, and they'll widen when volatility increases. So that's kind of the basic way Bollinger Bands work. And there are a lot of different ways to use them, but there's one really valuable way to use Bollinger Bands during market sell-offs, and it's what I call the rubber band effect. And so we'll focus on it specifically for the recent market sell-off, but I want to show you some past examples, and I'll actually zoom out even further here on the chart. I've got 2 years worth of price action pulled up. I'll go out even further to 3 years, and we can go back. But basically, what I want you guys to look at is what I call the rubber band effect. When a lower band breaks, we want to use that as, which was once a dynamic support level, dynamic being that these bands obviously move with the price action and volatility of the underlying security. And that serves as a support level. So generally when the market is obeying the bands, it will bounce off the lower band and go up to the upper band and bounce off the upper band and go to the lower band. But when a band breaks, like it does, as we'll look at here as I zoom in a little bit so you can see it better, price will follow that band or even trade outside of it. So that happened here. This was back in July, August of last year. All right, so instead of bouncing off the lower band here, and this was an area of support on the lower band, and you can see there was some horizontal support there as well. The price broke the band and it's trading down along the band and outside of it. And when this happens, as it is right now with the current sell-off, we want to mark the area where that band broke. So you'll see right here, the lower Bollinger Band broke. And why do I pay very close attention to that? Because, well, we can say up until, we'll see what happens with this one, 100% of the time that one of these bands breaks on the S&P, the price comes back up to that level. 100% of the time that's happened since the beginning of the market, price has come back up to that level. And that's of course evidenced by the fact that we just hit an all-time high in the market. The market tends to go up over time, right? So we know that over the long haul, the market is going to trend up, and that's good information to have. Now, the good news is this rubber band effect tends to happen fairly quickly, so we don't have to wait years or decades for that rebound to happen. And another point to make here too, in terms of sell-offs, is sell-offs are always steeper than inclines in the market or uptrends. So price always falls faster than it goes up. And that's just simply fear and greed in the market. When people become fearful, they tend to overreact, and that's what drives prices down on the market. So in terms of the rubber band effect, what happens is when we break one of these lower Bollinger Bands, we're looking for price to come back up to where the band broke. That's our new, very significant level of resistance. And you'll see here where the band broke here at the end of July last year. A few weeks later, we came right back up to that level here. Okay, so this causes a lot of fear and panic in people. But if you know how to read these rubber band breaks on the Bollinger Bands, it can actually create a lot of opportunity for you. So there's an example. Here's another example where the lower band broke. There was a steep sell-off. This was back in May of last year. And within the matter of only a couple of weeks, what happened? We're right back trading up at that level. And oftentimes when we do that, you'll see an extended uptrend. Let's keep going back. This was the major sell-off in December of 2018. Here's where the band broke. Okay, within just a little over a week, we tanked. The band broke around 2,600 and we sold off all the way down to 2,350. But what happened? A couple weeks later, we're right back at that level and big uptrend. All right. Here's another one. Major sell-off, rebound. We didn't quite get back up to that level on this first rebound, but we eventually did over here. Okay, let's keep looking. Here's another one. March 2018, the lower band breaks. What happens? We come right back up to that level. Okay, oh, this thing is, sorry, let me get my menu bar out of the way here. And here's another one. This one is January 2018, the lower band breaks. Steep sell-off, everybody's panicking. And shortly after, we're right back up to the level. Right, so you can go back. Some are more significant than others. I mean, this was also a band break. We're right back up. These are some more minor ones. But you can go back as far as you want in the market, and you'll find that the rubber band effect occurs over and over again. So here's our break. Here, just around 3,200, right? So our horizontal level of support. Remember I said I map out these century marks. There's our band break. So the anticipation is that we will come back up and retest 3,200 at some point. But remember, it always takes a little bit longer to get back up than it does to fall. So just keep that in mind when you see these happen. So that's all well and good, but then how do we know, we don't have a crystal ball, how do we know when the rebound is going to happen? So I'm going to give you guys a couple of little tips and tricks that I use to help gauge the reversal in the market. One is, and of course we can't see it yet here because it hasn't happened yet, but one would be a close back above the lower band. So like here in this one, here would be my, oh, sorry, I got the wrong drawing tool there. This would be our close back above the lower band. That would be an indication that we are back into the volatility range and back into potentially a move up in the market to the upper band. Same thing here. This is more of a minor one, but once we see that close back above, that's a good indication that we're recovering from the sell-off. If we want really strong confirmation, I'll wait till a close above the middle band. So like here, we closed above the lower band, but then we went into some sideways rangy price action. And when we finally got the close above the middle band, we finally went up and retested the upper band. Same thing here. So that's really what I look for in terms of determining when is this thing going to turn around. I mean, this sell-off in December of 2018 was very steep, and that first close on a bullish candle that we got above the lower band set the market back off into an uptrend. And certainly once we got above the middle band, we had really good confirmation the trend was going to reverse. Okay, so now we're watching for a close above this lower band. We're far from it right now, so I don't anticipate we'll probably see it in the next trading day or two, but we could. So we want to also look at our next level of support. Okay, and I mentioned the century marks, but we can also look for visual horizontal levels of support as a good indicator. Let me clear out the drawings again so it's not so messy. So what I'll do is I'll look for visual levels of support. So like 2950, roughly the 2950 level, is going to be a major level to watch for a reversal. Okay, so you see this, if I zoom out. This is an area that we had previously sold off in on that December 2018 sell-off. And then once again here in May of 2019, and you can see we found some resistance there. And this level is very significant because look what happened when we really finally broke above it. The market took off. So this is a level that I'm watching, 2950 on the S&P, that I'm watching very closely for some sort of price action indicating a reversal. And so that could be, a reversal candle off of this level, a close back above the lower Bollinger Band, something of that nature to give me an indication that we may be headed back up to where the band broke and seeing that rubber band effect take place. And certainly these Bollinger Bands can also be used for these sell-offs as well. If you didn't catch the move off the top at 3,400, one thing I look for if I'm looking to short the market is I'm looking for a couple closes below the band, and then I'll short on a sell stop order below those two candles. So like here was the first close below the band. Here was the second. I put my sell stop order just below this candle. And then I would take a trade to the short side. And that will help keep you out of some whipsaws. Like here was a couple closes below the candle. So I would have put my sell stop below the low of the second candle, but we reversed. Same thing here. Actually, no, this would have been a good trade because we had a close below the candle there, or sorry, below the band. Second one was there, so my sell stop would have gone just below the low, and could have made some money on that one. Basically, I look for a 2-to-1 risk reward on these types of trades, or I'll trail my stop above the high of each candle. So that's a way to play these on the short side as well. They can work out really well. Here's another, you get a couple closes. You could have taken this whole move to the downside, trailed your stop after each candle. But mainly I want to point out that we want to be keeping an eye out for that rubber band effect, because eventually, and volatility is very, very strong here. You can see how wide our bands are, right? So as of the close today, the upper band resides at 3503 and the lower at 3078. So we've got about a little over a 400 point width in that band. When you look at some of these other major sell-offs, the width in our bands here on this one, let's see, we got to 3849. So we were about the same width in the volatility bands on this December 2018 sell-off as we are right now. And so that could be an indication they're probably not going to stretch too much more before they come back together and volatility reverses or consolidates and goes back down. So we wanted to hold this session so you guys can use this information in your own trading and investing, regardless of what strategy you trade, but also hopefully give you guys some peace of mind that that these sell-offs do eventually end. The market does eventually rebound, and that's why we teach our students very strong, diligent, methodical money management and position management techniques, so that they can stay in the game when the inevitable rebound takes place. But these are some tools that you can use to help determine when the market may be headed back the other way, and when you may want to take caution in it is selling off. I always get cautious when we're trading near the lower band on the S&P, and sometimes that can serve as a dynamic support level and a rebound in prices. But I still am cautious. I want to wait for a confirmation that we're actually going to bounce off that lower band, because if we don't and we break below it, then I start to look for opportunities to short the market. All right, so any questions come through, Richard, that we want to address?
Let's see.
If you guys have any questions, feel free to type them in the Q&A box or the chat box.
Here's kind of it's a little specific to one of our trade alert services, but I think we can maybe make it a general question. Like if, let's say someone's kind of looking at this rubber band effect and they're, let's say they went long on something and now they're kind of having to play defense. Imagine, with the rubber band effect, is it more inclined to roll those types of positions versus?
Yeah, in fact, yeah. And so you're talking about option strategies.
Yeah.
Yeah, if you're short premium, rolling is actually works very well in these sell-offs because, of course, as the market sells off, implied volatility goes up, which is directly correlated to options premiums. So it's a positive correlation. So when volatility goes up, premiums go up, and that's good for rolling a short premium because you're going to get high premium, and then when the rebound takes place, then of course implied volatility goes down, premiums go down, and you capture that volatility crush. So yeah, in fact, I actually really love situations like this, even though they cause a lot of people to freak out and panic. They're great opportunities. And if you're really astute, you can short premium right now. IV implied volatility is so high and premiums are so high. If you can time a rebound on these things, you can sell some premium and really make a killing on some of these rebounds. But again, I'm cautious. I'm a fairly risk averse trader, so I really wait for confirmation of that rebound.
Yeah. Let's see.
I saw Dennis's question. I want to answer that real quick. Dennis asked, why do I prefer Bollinger Bands over Donchian channel or Keltner channels? I don't necessarily prefer them over those, Dennis. In fact, I use Keltner channels as well. They just give different information. So the main difference between, I don't really use Donchian channels much, but the main difference between Keltner channels and Bollinger Bands, if you're not aware, is Keltner channels simply use a standard, they look very similar. They have a middle band, which is a moving average, and then two outer bands. The Keltner channels use standard deviations, and the Bollinger Bands use, I always blank on, I'm drawing a blank on it. Sorry, I had that backwards. Bollinger Bands use standard deviations, and the Keltner channels use average true range. So that's really the difference. So the basically what that means in terms of interpreting them is the Bollinger Bands are more volatility based. So they're gonna, for instance, widen drastically like this when volatility picks up. So they're a better tool, I think, than the Keltner channels for identifying this rubber band effect. But the Keltner channels are good too in terms of finding support, dynamic support and resistance in trends. So I kind of use them different ways. So that's a good, I want to answer that because that's a good question. So somebody asked, do I trade for a living? Yes, I do. I do trade my own capital for a living, and then I also manage the Altos Capital hedge fund, and I trade professionally for our clients.
And Praveen wanted to know if Trade Trend had any sort of luck with this sell-off or not. Did it?
Yeah, we didn't really want to make the session too much about Trade Trend, which is our signal software, but I can show you what the signals were on this. Let me clear these out. So this is our trade trend indicator. It actually caught the sell-off right at the top. So it gave a sell signal. Let me actually get rid of this. Let's see. Oops. So it gave a sell signal here on February 20th before the sell-off happened. And then it gave the suggested entry price if we were going to short the market. This is the SPX. sell stop limit order at 33.35. So the entry would have been on a sell stop order right about here. And you can see that triggered here the next day on this candle. So it actually caught it before it happened. And so this is our predictive indicator software. I actually use this to help make decisions in my hedge fund. And it did a really nice job at picking that sell off at the very top. Valentina's asking, what does it say today? Well, Valentina, on the S&P, it's actually still has an open short trade. So you'll see the horizontal lines here are the trailing stop levels. And these will tighten up as the volatility and momentum slow. So eventually, tomorrow I would anticipate the trailing stop will probably trail way down here, but it'll lock in. It just locks in the profit as the market moves, and it keeps it wider when volatility and momentum are stronger, so that we capture more of the trend. So right now there's no signal to go long. But this would be like an example of a long signal. It gives you up to 3 bars of warning. So it gives you the entry price on the arrow. When the arrow prints, it'll tell you the suggested entry price. And once that price is hit, you'll see the green dot and then your trailing stop levels. But we don't have a green arrow. We'll eventually get a green arrow at some point when this reverses.
That's all I got.
All right. Well, if you guys have any other questions, feel free to reach out to us via email. You can email us with any questions you have about our products and services at support@thetradingprofit.com. If you want to try out the trade trend signals, we do have free trials on various platforms like TradeStation, NinjaTrader, TradingView. We don't have a free trial on every single platform, but we do on most, and you can find those at tradetrend.com. But if you have any general questions, feel free to send us an email. Thank you guys for joining. Thanks, Jim. Thanks for being yet. Appreciate it. Glad you could join us tonight, and we'll let you know when we hold our next session. We try to hold one of these once a month, so we'll probably see you sometime in March. Hope you guys have a great rest of the week and a good weekend.